I think if you flash back to how technology performed last year, it was one of the worst performing sectors. And as we saw the turn of, the peak inflation report coming in September of last year, that's when we saw that, a change of events taking place, where we saw the dollar beginning to peak. We saw rate expectations by the Fed beginning to come off. And that really was an important catalyst for a rally in equity markets. And what we've seen in 2023 has been a continuation of that rally until we had the banking crisis. I think what investors are looking out for right now is they are seeking confidence in their belief that the Fed is going to begin to cut rates, and that policy path will, favor longer duration assets like technology stocks that were the worst performers last year. And some of these technology stocks, as you mentioned, have had better results. They also have less of headwinds coming in their way this year, and hence, they've been benefiting from the macro environment.
The banking saga obviously has created some uncertainty, and we've seen volatility in some sectors of the market here. But I think investors seem to be willing to look through that. They may be avoiding banks, but they're still interested in owning equity at this stage. Are they right to do so, or are they misunderstanding the timing of the impact of these interest rate hikes that we've experienced?
I think that's a great question. And I think what we're seeing in the market is clearly, ever since we've had this banking turmoil, we are beginning to see a widening of credit spreads. Now, it's important to remember that even before the banking turmoil erupted, banks were in any case tightening their lending standards. Despite the banking turmoil, we have observed that equity earnings revision estimates have remained fairly resilient. And within that, the geographic frame, we've seen Europe really stand out with earnings revision estimates actually coming out the highest amongst the globe. So I think what investors are really doing is they're fine-combing, winners and losers amidst this banking turmoil and amidst the after effects that we're likely to feel, come out from this banking turmoil. And what we've seen is by looking at three scenarios of, a recent reflection of what just recently happened at the Eurozone debt crisis, observing the credit spreads that have, widened over the course of since March of 8th, and also looking at a hypothetical scenario of whether credit spreads could rise another 200 basis points from here. What we found is not all sectors were impacted equally. So equity sectors such as, information technology, utilities, more of the defensive sectors, they've actually been able to have a more resilient performance in comparison to the well-known cyclical sectors, which such as energy, real estate, financials. So those are the sectors that have been penalized a lot more. So I think what investors are doing is they're getting a bit of a lead from the earnings revision estimates, as in 2 weeks' time, we're going to be hitting Q1 results. And they're also looking at which sectors historically have fared better when we've seen recent turmoils take place in the financial market.